Hey, I'm here with 𝘾𝙊𝙉𝙉𝙃. She works for Bank Central, and she has the scoop on the latest and very much upsetting the LLPAs. What is that, Kim?
The loan level pricing adjustments.
Yeah.
So the loan level pricing adjustments come down at the directive of the FHFA, which is the Federal Housing Finance Agency. And they provide the directive of the loan level pricing adjustments. And what loan level pricing adjustments are is and there's different tiers and different at different credit scores and at different down payment percentages and stuff. We have adjustments to the base interest rate of the day, creating loan level pricing adjustments, which is why different people get different interest rates when they are purchasing a home. So that's kind of summarizes what a loan level pricing adjustment is.
But LLPAs are fees.
Yes. I mean, it can be a fee if you want to pay the fee in points instead of just absorbing it into the interest rate. So you can consider it that way. You don't have to consider it that way. So when we look at interest rates for the day, specific to that person, it's going to post interest rates and it's going to each rate is going to have its loan level pricing adjustments and it's going to have its ending price. And lenders, have to price within these certain categories of rates. And so you can move within those rates. If you want to pay, if you want to pay those fees outright, you can move the rate. Or else you just price it in and you get a different interest rate, if that makes sense.
Absolutely, absolutely. So let me share my screen real quick. Share. So there you go. Can you see this?
I can. Perfect.
Okay,
I was actually going to provide that to you.
So can you help me understand what we're looking at and then how this is actually impacting a buyer, and should they be afraid?
Yeah. So I think, no, first and foremost, you shouldn't be afraid. I mean, this industry is ever changing, right? We have changes every day to this industry, and also interest rates change every single day. So you have to keep that in mind as well. When people are looking at the changes and the impact, you got to think every single day that baseline rate that we're working off of can change. So what you're looking at, we call this the heat map. And this shows you the changes. This isn't the actual loan level pricing adjustments. This is the changes to the loan level pricing adjustments from the old ones to the new ones that came into effect after it was for loans sold on or after May 1st of this year. So you can see the situation didn't get worse for everybody. The green is improvements. And some of the yellow is improvements as well. So you can see they shift the colors in this map depending on the severity of the change. So you will see that not everybody had a change for the worse. Some people had a change for the better. So particularly, you'll look at the people at the higher or at the lower down payment percentages. So the higher loan to value. So over the 95% loan to value, meaning you're only putting 5% down or less. They had a lot more positive changes. The people in the middle are kind of getting the most severe changes. And then it actually, it did improve for some people. So the old chart stopped at the max credit score is like a 740. So if you're over a 740, you're now getting some positive improvements if you look up at the top of the chart there. So there are some benefits to the changes they did make.
Okay.
Yeah. So before, if you were a 740 or above, you were just lumped into the same category. Now, if you're higher than a 740, there can be some benefits there for you.
Okay. So what would you suggest to somebody that is a 759 or between in that bracket of 740 and 759 and wants to put 20% down? What would you recommend?
Okay. So this first chart is the heat map again. Not with the different colors, literally just green and red or no change at all. So this shows you changes for the better, changes for the worse, or no change at all. The bottom chart is actually the new loan level pricing adjustments, which is probably what you should pay more attention to. So instead of looking at the changes, look at what the chart is showing you, what the actual hits are to interest rate pricing. So the biggest takeaway I think from this is, I think everybody immediately thought, oh, I'm just going to let my credit go into the tank because I'm going to get a better credit. I'm going to get a better interest rate if my credit score is worse. That's not true.
That. How crazy is that?
Yeah, that's not true. The hits changed, but somebody with a 780 credit score is still going to get a better interest rate than somebody with a 640 credit score. So there's still those benefits to maintaining your credit. Now, the down payment percentages are a little bit different now. So as I mentioned, some of the biggest improvements are the people at the lower down payment percentages. The thing to keep in mind, though, is when you're looking at a mortgage, it's not just the interest rate. The people at those percentages above 80% loan to value, so people putting less than 20% down, are going to have mortgage insurance, right? So there's still, the people with 20% down are not going to have that mortgage insurance. So that's one thing to consider. The other thing to consider is, yes, there are some major improvements for the people above 95% loan to value, so putting less than 5% down, but they're going to be in the highest mortgage insurance bracket. They're going to pay the most money for mortgage insurance. And it notches down. At 5% down, you pay a little less. 10% down, you pay a little less. 15% down, you pay a little less. So you have to keep that in mind when you're looking at this chart. So you asked me for somebody at did you say 740 credit score with 20% down?
Yes.
Okay. So if you look at that line, does my cursor, do you see that on the video? Okay.
I see it.
So at 740 with 20% down, you're looking in the category of the 75.01 to 80%. So your hit for that rate is 0.875. So when you talk about the fee, if you wanted that baseline rate for the day without this loan level pricing adjustment, what that equates to is you're paying 0.875 in points for the rate. Does that make sense?
Yep.
Okay. So, and 1 point is 1% of your loan amount. So you're paying, if you want to just pay that fee outright, you're paying 0.875, but you don't have to. You can just adjust your interest rate higher if that makes sense and not pay the points. So if you look along that line, you're going to see the pros and cons. If you put more money down, you're going to have less of a hit. Okay. If you put less money down, it kind of teeters up and down from 80.01 to 85. You're looking at 125 worse. Okay. But then you jump again, it gets a little bit better in the higher brackets. And typically you see that because they see less risk because there's mortgage insurance attached to it, right? So they have that mortgage insurance company.
That makes sense. Okay.
Yep.
Yeah.
So this is really nothing, this isn't super new. There's always been that 80% has kind of always been that sweet spot when you put more or less down. Usually the hits to the rates are a little different. It's never so much so that it makes a huge difference, if that makes sense.
Yeah. Has the so how does that compare before those LLPAs came into play? So last year, how would that look like?
So then you look at the heat map here. So if you look at the 740 at that same category, the 75.01 to 80% down, we've gotten 0.375 worse. So before May, the hit at that rate would have been a half point instead of the 0.875. So it got 0.375 worse.
Okay. Okay, very good. So
Yeah.
there is really no reason for buyers to be concerned about, you know, the hype in the media, but it's actually really more important to kind of take a look at what, you know, their personal situation is, and what basically is best for them in terms of like, how much do they want to put down? How much is the mortgage insurance, and what their final monthly payment is? It seems like the final monthly payment is where it's at.
Yeah, for the most part, yes. I mean, that's very, very important. And that's where everybody's situation is different. And that's where it's best for each individual person to just get with their lender and figure out the best path for them. You know, these changes and everything, I wouldn't let this derail your thoughts in life of, I want bad credit. You know what I mean? Like, you still want good credit. You want to try to work towards that if you want the best benefit for the best interest rate. And then, you know, obviously the money down percent, that's something that we've always taken case by case basis anyway. Depending on where credit scores hit and what that person's credit profile is and what their debt to income ratio is, sometimes mortgage insurance is not that much on a loan. And so I have people sometimes that have 20% to put down that choose to put less money down because they'd rather keep that money in their pocket, because the hit that they're taking for the mortgage insurance is not very much. So when, you know, each person, they should actually just consult with their mortgage professional, look at their options and figure out what's the best path for them.
Okay, very good. And I think also there was a huge focus on the negativity of this LLPA, when in fact there were actually quite a few other improvements in the lending industry in general, or specifically to government loans, of course,
Yeah.
which is where actually the influence is. So I know that FHA has made some adjustments in PMI, reduced some of their fees. And that has had some impact. Is that correct?
Yep, that's correct. So FHA in general, it went from a monthly mortgage insurance factor of 0.85 to 0.55. So that's a pretty significant decrease that we saw.
Doesn't sound like a lot, does it?
It's significant. So to give you an idea of numbers, if you were buying a $400,000 house and you were putting 3.5% down, at the old mortgage insurance rate, your monthly mortgage insurance would have been $271. At the new mortgage insurance rate, you would be $175. So it's almost a difference of $100 on a $400,000 purchase with 3.5% down. So FHA is significant, right?
Okay. Wow.
Yeah. Yeah.
Can you stop sharing so we have your beautiful face on the screen again? There you go. Awesome.
And then VA also had some improvements, not as significant as FHA, but VA did reduce its funding fees. They went back to what they were before they made the last increase. And so VA went from, when it's your first use of VA eligibility, it went from 2.3 for the factor to 2.15. And then subsequent use, it went from 3.6 to 3.3. This isn't as big of a deal. It does save you money. So most of the time, people choose to roll that funding fee into their loan amount, so they're not paying it out of pocket. But to give you an idea of what that does, also looking at a $400,000 house, if you were first use of VA, your old funding fee would have been $9,200. Your new funding fee is $8,600. So it saves you $600. Subsequent use, it would have gone from $14,400 to $13,200. So about a $1,200 difference, but it's still an improvement.
Oh, yeah, definitely. Is the funding fee on subsequent use so much higher because of risk, or because they're trying to discourage subsequent use?
I don't think they're trying to discourage it. I just feel like it's just the guideline I think that VA set to, I don't want to say recoup the cost, or you know what I mean, the benefit of insuring loans, but it's just the different hit that they have from first to subsequent use. But you can reduce that anyway. I see a lot of people that are in that subsequent use bucket that will put a partial down payment down. So if you put at least a 5% down payment down, it goes to, I think it's 1.5 now instead of 1.65. So
Nice.
a lot of people will do that on subsequent use to really, I mean, that cuts it in half.
Wow. But that's very cool. So there are definitely options out there. My takeaway is definitely, and that's what I'm actually also telling my buyers, they really have to talk local lender, because they know what's going on in the market. And they really have to look at everything and really strategize what works best for them.
Absolutely. Absolutely. And I think one of the biggest takeaways too with the loan level pricing adjustments is, you know, get educated and get informed. You know what I mean? Obviously you see the stuff on the news, but if you just really want to know the true nitty gritty, get with your mortgage professional and they'll break it down for you. I think the biggest takeaway is it's not, you know, the person with the higher credit score is not getting a worse interest rate than the person with the lower credit score. I think the best way to look at it is they're closing the gap. They're closing the gap in the spread between the rates at the different credit scores. And so, but again, the other thing to really take away from this is rates change daily anyway. So it's, you know, to think, oh, well, I would have, you know, it would have been a half point in pricing worse for me 6 months or better for me 6 months ago. Well, but the rate might have been different. So everything's always moving.
Flux, yeah, absolutely.
Yeah, exactly. Yep.
Okay, so I'm gonna have to ask, where are rates today, or what do you see? What's your gut?
I have I don't even know anymore. It is I mean, obviously I get asked that question constantly, is where do I see rates going? And at this point, honestly, it's been impossible, nearly impossible to predict. So some of those previous signals that we would see that would possibly create a change in rates, it's not even always responding that way anymore. So it's nearly impossible to truly know where rates are going to go. Are we still really hopeful that we're going to see a decrease in rates in the next year or two? Yes. Do we have a perfect crystal ball forecasting that? No, but we're still hopeful for it. You know what I mean? We kind of joke in the industry. It's like, if the best way to make interest rates go up is to tell people to float. And if you want rates to go down, tell people to lock, because it's just Murphy's Law. It's responding in the opposite direction of what we forecast.
Yeah, good point. Yeah. Right.
So pretty much everything's kind of thrown out. It's just we take it day by day.
Yes. So, well, thank you so much for all that insight. That was awesome. And if you out there, any buyers have any questions, or homeowners for that matter, please talk to Kim. She's great and will help you best way she can.
Awesome. Thanks, guys.